information. So we're going to jump right into it. So today's agenda, we're going to look at your greatest asset. We're going to look at the life insurance solution. We're going to look at core benefits of life insurance and then the two main types of life insurance. We'll take a deeper dive into both of them, a deeper dive into term insurance and permanent life insurance, and then determining the coverage that you need and special planning applications and when to buy life insurance. And then we'll talk about the next steps. So we are going to let's go and jump into this information. Your greatest asset. What is your greatest asset? Many times I ask this question to a lot of people and ask them what is their greatest asset. And the things that they name are their house, their car, their savings, whichever one has the most in it or is the most expensive. However, your greatest asset is not your house, your car, or your savings account. Your greatest asset is your ability to earn income. Therefore, your greatest asset is you. So the income earning potential is what funds your current lifestyle and all of your future financial goals, such as your mortgage, your kids' education, your retirement. So you are your biggest asset. And the risk of an unexpected death or a critical illness, critical injury, or chronic illness or terminal illness slowing you down means that the immediate and possibly the permanent loss of this income stream. So you are your greatest asset. I could stop right there, but we're going to go deeper into that. The life insurance solution is what you need to protect your asset. So, how life insurance works is real simple. The definition of life insurance is a contract between you, the policyholder, and an insurance company. And the promise is in exchange for regular payments or premiums, the insurer promises to pay a specific sum of money, the death benefit, to a person or entity you choose, which is a beneficiary, upon your death. So the goal, the death benefit is designated to replace the income you would have provided financially protecting your loved ones. So the key is this: life insurance is not for funerals. Many of us have been taught that life insurance is for funerals, and life insurance is not for funerals. Life insurance, one of the things that life insurance is for, is the goal is that the death benefit is designed to replace the income you would lose or you would have provided financially protecting your loved ones. So the death benefit generally is paid out tax free and in a lump sum. So that is what life insurance is, and that's how the life insurance solution works. So life insurance, more than a death benefit, life insurance provides essential financial security and peace of mind for income replacement, replacing um, years of lost salary to help you your family maintain their standard of living. Debt payments, so paying off major debts like a mortgage, a car loan, or outstanding credit card bills. Future expenses, funding long-term goals such as a child's college education or a spouse's retirement, and then for final expenses, covering funeral costs, medical bills, and other end of life expenses. So if you get enough protection to cover all of these things, then the funeral expenses would be encompassed in there. You'll definitely cover that. So life insurance, I keep saying that, is not just for funerals. And That is one of the core things I want to get you to understand. The two main types of life insurance are term insurance and permanent life insurance. And we'll break it down on this chart. The duration, term insurance may be for a specific time, 10 years, 5 years, 1 year, 20 years, 30 years. And then permanent life insurance is for your entire life. Um, then both the insurance can have cash value. The term insurance has no cash value. The permanent life insurance does have cash value, and it will grow, and it can grow tax deferred and come out in some cases tax free. And then the premiums generally lower on term insurance and level premiums for the life of the term. And then for permanent life insurance, it's generally higher than, of course, term insurance. And then premiums may be level for the life of the policy. And then best for the term insurance is best for temporary needs. In other words, like covering a mortgage or raising your young children. When your children are young, you may need more protection. So term is good for a season. Also, sometimes you take out loans at the bank and they want you to get life insurance to cover basically the loan in the event that something were to happen to you. And then permanent life insurance, it's best for lifelong needs. In other words, estate planning, final expenses, and wealth building. So that's the two basic types of life insurance. So let's take a deep dive into term insurance and look at it. Term life is simply simple and affordable, and it's simply basic protection. And what is it? What is it? It's coverage for a specific period of time. If you die during that term or that period, your beneficiary gets the death benefit. If you outlive the term, then the policy simply ends. And that is just how simple a term is. And it is more affordable than the permanent policy. So sometimes it is a good choice for you to have a term insurance to protect you, your biggest asset, your greatest asset, than jumping directly into a smaller cash value policy. So it offers the largest death benefit for the lowest initial premium, making it ideal for young families with high financial needs, but not a high income or limited budget. So the consideration is this: premiums are much higher if you renew the policy after the term ends, or you may need to get another policy when that term ends. But that is one thing to consider. And just remember, term insurance is considered a temporary solution for a permanent problem. And that permanent problem is you need to have permanent protection eventually. But term insurance can get you protected for a season. So let's take a deeper dive into permanent life insurance. Permanent life insurance is lifetime protection and cash value. So what is it? It's protection that lasts for your entire life as long as your premiums are being paid, or if you have paid up life insurance. A lot of people have not even experienced or do not have any experience that your cash value policy does not always have to be paid for your whole life. We can design policies that can be paid up and you will still have permanent protection for the rest of your life. The cash value feature, a portion of your premium is saved for creating a cash value that grows tax deferred and can come out tax free in some cases. So accessing that cash, you can borrow against it, or you can withdraw from the cash value for any purpose. So one of the upsides for the cash value is your for the permanent policy is your cash value is accessible. So you can use it to supplement retirement income, for college tuition, for emergency fund, because you have a chance to access that cash value in that policy, whether it's through withdrawals or borrowing against the cash value. Key thing to note on the withdrawals, they will reduce the policy's cash value and or death benefit, because with a cash value policy or a permanent life policy, everything that comes out of the policy comes out of the death benefit. So the types of cash value or permanent policies include whole life, which has guaranteed premiums and death benefit and cash value, and growth with that cash value, and universal life, which has flexible premiums and death benefit and cash value as well. So we just have to determine what works best for you when looking at protecting your assets, your biggest asset, which is you. So how much life insurance do you need? Your ideal coverage amount is uniquely solved and found out with the financial situation by looking at the dime method. So we in the industry use the dime method, and the dime covers your debt, number one for the D, and debt is your total outstanding debts, which is your mortgage, your car loans, your credit cards. Really, it's just any debt that you have. You want to have enough protection to cover that debt. And then your income. You want to look at how many years of income replacement that are needed to support your family and take your family on into the future if you were no longer there. A typical guideline is my slide says 7 to 10, but I look at more 10 to 15 times your annual income. And then the M in the dime is the mortgage. Your outstanding balance on your mortgage, you should definitely have enough for your primary residence, so that if something were to happen to you, that coverage could also pay off your mortgage. And then the E in the dime is education. The estimated cost of college tuition for each child, and you should definitely have enough to cover that. So you subtract any of your liquid assets and existing insurance that you may already have, and then that will be the gap that you find is what you need with your dime. So the dime is a great and simple method to determine how much income, how much life insurance you need, and how much of your income you need to protect, because, or actually not just your income, how much you need to protect you, because you are your biggest asset. Special planning and applications. The life insurance also can be used in estate planning and financial planning. Beyond income replacement, insurance is a powerful financial tool for estate planning and for estate liquidity, providing immediate cash to pay for estate taxes, ensuring valuable assets like a family business or property, and you don't have to be sold to have money and do that real quickly. So if you have life insurance protection and have enough in place, you definitely can solve these problems when they come in the event of an untimely death, or even when something comes up and you become ill and you need cash, and you have a permanent policy with cash value that you can borrow against, then you don't have to sell property or liquidate a business or anything like that. Also, for wealth transfer, one of the greatest ways to transfer wealth in this country is through life insurance, and it's an efficient, generally tax-free way to leave a specific inheritance or legacy to your family. And many people miss that and don't understand it because they think, like I told you earlier, that life insurance is for funerals, but life insurance is for wealth transfer. You can pass on as much as you like for to your next generation. And then charitable giving. Many people name a charity as a beneficiary to leave a significant leveraged gift to their charity of choice. And you can do that as well because you get the opportunity to choose your beneficiary when you put your policy in place. Also, one of the things that a lot of people miss with getting life insurance and getting protection is special needs planning. Funding for a special needs trust to care for a dependent with a disability without jeopardizing their eligibility for um, benefits, government benefits. So if you set up a special needs trust, and you can definitely set that up and put that money away for a child that may have special needs so that they can always be cared for and always have funds um, that do not hinder them getting assistance from government fundings and government programs. So there are a lot of ways that you can set up and plan using life insurance to protect you, your biggest and your greatest asset. So when to buy life insurance? The best time to get coverage is now, always now. And people will tell you, I can wait, and we can get together next month, and we got the danger in that is because we don't have a crystal ball that says, hey, when something is going to happen or when you're going to have an accident or when you may get sick, then the best time to get coverage is now. And premiums are partially based on your age and your health. So the younger you are and the healthier you are, the lower your insurance premiums will be. And then it gives you peace of mind. It provides immediate security, knowing your family is taken care of and protected against the financial catastrophes of life. So it's just a good deal to get life insurance as quickly as possible. And then you should reevaluate your life insurance as you have life changes, and your needs for insurance may increase with major life changes. You get married, you should evaluate it and look at getting more coverage or getting coverage on your spouse if they don't have it, and then increasing your coverage if possible. You're buying a home, you want to definitely look at, like that dime says, the M in that dime, for getting enough more coverage to cover that mortgage. And then having a child. You definitely want to have more to protect that kid's education and as well as having funds in the event, God forbid, if something happened to you, whether you become ill or if you, God forbid, pass away, you're leaving money for that child, leaving a legacy for that child. And then even for starting a business, because you are with your permanent coverage, you have cash value in there. And as it grows, you can start a business. You can, like I said earlier, you may get a bank loan and they may require that you have life insurance to cover that loan for your business. So a lot of things in life happen, and you have to continue to evaluate your protection and your coverage. You just don't get it and then forget it. You continue to make sure that you are protecting your greatest asset, which is you. So take action, secure your future. Number one, assess your needs. And one of the best ways to do it is using the DIME method to determine your total financial obligations and how much protection you need to protect you, your greatest asset. And then evaluate your budget. Determine the type of policy you need. You may need a term policy to start out because your budget may not be able to cover a permanent policy and also cover the amount of protection that you need. You may need a little of both. You can start with partial permanent and then put the term in place. So you just need to look at your budget and your financial goals and see what type of protection you need. And then review your beneficiaries. Ensure your designated beneficiaries are up to date and that they reflect your current wishes. So make sure that they are people that are going to do what you want this money to do. So, and sometimes you have to evaluate your beneficiaries. They may change over the life of your policy. And then consult a professional. Work with a licensed financial professional or a insurance agent to compare policies and customize your coverage to meet your needs and look at your situation. So, looking at protecting your greatest asset, which is you, the first thing you do is, as we titled this short lesson this evening, is number one, you want to identify, which we have, your greatest asset, which is you. So you have to look at that and protect your greatest asset, and then look at what works for you and what works for you financially, as well as how much coverage you need. So protect your future, ensure your greatest asset, which is you, and you will be well on your way to a strong financial future. Remember, protection is first, and you must always look at protecting your family, number one, from the event of an untimely death, and then also from terminal illness, critical injury, chronic illness, and even we have policies that even protect against Alzheimer's. So, understanding, protecting your greatest asset, which is you. And I want to thank you for your time this evening.